Hey guys, welcome back again. In the fourth episode, we have talked about the different candlesticks and what each of them had to say with regards to the market participation. And one of the main candlesticks of our discussion was the pin bar candlesticks. The pin bar is one of the most popular reversal candlestick patterns. You can use a pin bar on all your different time frames and it can be traded across many different markets, making it a very flexible trading candlestick pattern. Most importantly, the pin bar candlestick is a reversal pattern and it can often help you find when a new swing, either higher or lower, is about to occur. Let's hop into a more detailed study about the pin bars. So what is a pin bar candlestick pattern? If you remember, a pin bar is a candlestick that has a very large shadow or a candlestick wick with a small real body. The shadow of the pin bar is at least 2 times the size of the real body. The tail or the shadow of the pin bar shows the area of the price that was rejected, and the implication of it is that the price will continue to move opposite to the direction the tail points. Now this pattern can be bullish or bearish depending upon where it occurs and how it is formed within the price action. The example here shows a bearish pin bar. The pin bar is formed with the price trying to break higher. In this particular market, the bulls are in control. But as soon as the bearish pin bar was formed, it shows that the bears have entered the market and are looking to take the price lower with a reversal. And this is exactly why the large candlestick wick is created, which shows that the higher prices were rejected and the bears are trying to regain control after the initial break higher. Similarly, a bullish pin bar shows rejection of lower prices. The large lower wick shows the bears were in control earlier, but eventually it was overcome by the bulls, and now the bulls are dominant and the market could reverse higher. Now the most important point is that the key to high quality pin bars is where they form in the market. As we discuss more about pin bars in this video, we will understand why the best pin bars are found at the key market levels or within the obvious trends. Let us try to understand the two pin bar types in greater detail. Let us start off with the bullish pin bar. Some of the highest quality pin bars are when there is an obvious trend in the market. In this particular example, the price is moving in a clear trend higher. We can see from the price action that the price is making regular higher highs and higher lows with this uptrend. For a bullish pin bar to make sense to a price action trader, we want to see it formed at one of these swing lows with the trend. Now the reason as to why the pin bar should be formed at the swing lows is that pin bar is actually a reversal signal, and we are looking to enter the bullish pin bar and make a profit as the price reverses higher with the trend, or simply we want to enter when the buying demand starts to kick in, and in addition to that we want to trade with the trend. In this particular example, the price forms a bullish pin bar at the swing low within the trend higher, and the rejection is quite strong, which will actually strengthen the bullish perspective even more. So in this case, we can enter a trade straight after the pin bar has finished forming, or we could use additional confirmations. A confirmation type of entry is where we are looking for the price to break higher and above the pin bar high. And when we see the price breaking above the pin bar high, we can enter long. Now let us take a look at the bearish pin bar setup to clear things even more. As mentioned, the pin bar can be both bullish or bearish depending upon where and how it forms with respect to the price action. The difference between the bullish and the bearish pin bar is that the bullish pin bar has a wick or a shadow rejecting lower prices, while the bearish pin bar has a wick rejecting the higher prices, which is a sign that the bears are more dominant over the bulls. Now, the other great time that you will find high probability trades with this candlestick in addition to a trending market is when the price is rejecting a level in the market that is of importance or an area of value. Now, these can often be the key support or resistance level or dynamic levels like the moving averages. In this example, the price moves higher into a key resistance level. We can see that the price rejects from this resistance level and forms a bearish pin bar. This tells us that the resistance level has held and the price may now be looking to sell off lower. and then we can either enter the trade the very next candle, or we can wait for the confirmation. That is, we can wait for the price to break below the lows of the pin bar candlestick. Moving on, let us find out which are the best markets to trade the pin bar. Now, the best markets to trade pin bar strategy are markets where the price has a solid amount of volatility, or the markets with a high volatility. The more the price movement and volatility, the more opportunities you will have to trade the pin bar, and also the bigger potential for large winning trades. But markets such as individual stocks that can often have large gaps like gap ups or gap downs are not ideal for pin bar trading. Instead, the markets which are fast and free flowing with smooth price action is actually good for pin bar trading. So markets like forex, crypto, etc. are the best candidates for this particular strategy. In trading, mistakes are bound to happen. Sometimes it may be due to lack of knowledge, and other times it may be due to how we conceive an idea. That is, if we understand a particular idea in a different context, that will lead us to confusion. So I will talk about some of the mistakes that you should avoid while using the pin bar trading strategy. The first and foremost mistake is to expect market reversals because of a pin bar. A trend, either uptrend or downtrend, will not reverse just because there is a pin bar on the chart. It takes more than a single candlestick to reverse a trend. Sometimes even a major news release has difficulty in reversing a trend. So what more of a pin bar? We have talked about the market structure or the different stages of the market and why and how they are formed. So you can watch the second episode to get more insights on this topic. So if you spot a pin bar against the trend, it does not necessarily mean a trend reversal is about to play out. The odds are that the trend will continue. The second mistake is giving too much attention or interest to pin bars. Now we have learned that pin bar represents price rejection. But here's the important thing. Price rejection can come in different forms and patterns, and not just in the form of pin bars. So if you focus only on pin bars and reversals associated with pin bars, then you will miss out a lot of other trading opportunities in the market. Now, the most important mistake of all, considering all pin bars to be equal. The point is, if you see a strong momentum on the upside followed by a small bearish pin bar, it is likely to be a pause in the price action as the bulls are in control of the market. And on the same note, if you see a weak momentum on the upside followed by a huge bearish pin bar, it is likely to be a reversal since the preceding price action tells you that the bulls are getting weak. So it's clear we should not treat all pin bars the same because they are actually not. And remember, the bigger the pin bar relative to the previous candles, the stronger the price rejection. It is always a good idea to compare the pin bar with the previous candlesticks to understand the price action logic. Now let us hop on to the pin bar trading techniques, starting with trading the pin bars with the trend. One of the simplest and most effective ways to start stacking the odds in your favor is to trade in line with the obvious trend in the market. When trading with a clear market trend, you are trading with the current flow and not trying to push against it. So the trick when using pin bar and trend trading is to look to enter from areas of value and important swing points, which are swing highs or swing lows. In this example, the price is in a clear trend higher, and so we will start looking for a bullish pin bar to get long. And when the price makes a swing low due to a short-term profit booking into an area of value like a trend line or a moving average or even a swing level, and then forms a bullish pin bar reversal candlestick, rejecting the lower prices, we could look to enter long trades. We could either go long as soon as the pin bar has formed, or we can wait for a confirmation to enter when the price breaks above the pin bar high. In case of stop loss, you can place the stop loss 1 ATR below the swing lows or the trend line or the moving average as ample buffer, or you can even place the stop loss below the lows of the pin bar candlestick in case you want a tighter stop loss. Now the target can be set as the next swing high or the nearest resistance level, or you can ultimately ride the trend and exit when the price breaks out of the uptrend structure. Now there are a few advantages by trading with the trend. Number one is that you don't require a precise entry to make a good profit. Secondly, you have better odds for the trade to work out as you are trading with the market flow. And finally, you have a greater profit potential as the impulse move is stronger than the corrective move. Moving on to the second strategy, trading pin bars from an area of value. Take this example where the price moves higher into a key resistance level. We know as a thumb rule that resistance is an area of value where sellers will be looking to short the market, or there will be a larger supply for the stock than the demand. So when we see a price rejection from the market level and it forms a bearish pin bar candlestick, this is a clue that the resistance level has held or the sellers are active, and this is an indication that the price may now be looking to sell off even lower. The important point to note here is that pin bars are reversal candlesticks which can help us make a trade entry but can't guarantee us a reversal. Now, since there is a strong price rejection from the resistance level, we can either take a short entry on the very next candle or we can wait for a confirmation. The confirmation in this case is when the price breaks below the lows of the bearish pin bar candle, and the stop loss for this trade would be above the highs of the bearish pin bar candle with a suitable buffer using the ATR indicator. And finally, the target can be set as the nearest swing low level or the nearest support level. Now, some of the benefits of trading at a support or resistance level are that you are trading from an area of value. Secondly, it tells you when you are wrong. That is, if the reversal fails, your stop loss will be hit and you will be out of your trade. And finally, it improves your winning rate as well as improve your reward to risk because of the area of value and also based on the degree of rejection from the level. Now, the third strategy is using a combination of moving averages and support resistance levels. So in strong trending markets, the price is unlikely to pull back towards the trend line or a moving average, or simply the pullbacks are shallow. Thus, you can look to trade from a 200 moving average. Now, by a general rule of defining the market trend, if the 200 moving average is pointing higher and the price is above it, then the market is on an uptrend. Now, on an uptrend, find key support and resistance levels using a higher time frame, or you can even use a more responsive 20 moving average. Then we have to wait for the price to come to an area of value, which could be a support resistance level or a dynamic support resistance level like the 20 moving average. And if the price comes to the area of value, and when you see a bullish pin bar or a price rejection from this area of value, then you can go long. You can take a long entry on the very next candle, or you can wait for the break of the highs of the pin bar so as to enter with a confirmation. If you are long, you can place the stop loss below the low of the pin bar or 1 ATR below the pin bar low. Now, if the price goes in your favor, then you can take the profits at the nearest swing high level or the nearest resistance level, or you can even use the 20 moving average as a trailing stop loss and exit when the price breaks below it. Now, on a closing note, pin bars will show up in any market condition on all the time frames. So be sure to understand the prerequisites and practice identify and trading them on a demo account before trading them with real money, because practice makes you perfect. Now that is it for this video, guys. I hope you have learned something new, and if you have, please do like the video and subscribe to the channel, and don't forget to press the bell icon so that you don't miss out on the upcoming videos. I will see you guys on the next episode. Till then, see ya.